If you're interested in being able to trade something that's even more leveraged than options with even better liquidity and even better market access, this video is for you. We're going to talk about the basics of futures, and these are a big part of what I do, but for slightly different reasons. So first, let's start with an example of why we might use futures, and it's actually pretty simple. So if you'll remember, on 22 June, there was a little piece of news that came across that Operation Midnight Hammer came through, and this is where the US dropped some bombs in Iran. And if you remember, 22 June was a Sunday. So what does that mean? It means that the market is closed, but not futures. So what ends up happening on Sunday, this is the prior close on Friday, and futures open at 3 p.m. Pacific time, 6 p.m. Eastern on Sunday. So this piece of news actually is highly tradable, even though it's Sunday and the market is closed. It's actually even more tradable because the market is closed, because there's less people that can access this. So what ended up happening? Very, very simple. I entered a short position there. I closed the position there. It kind of went down, and then I waited until it retraced back up to take the exit. So I ended up selling to open a position when S&Ps were at 59.88-ish, closing them when they were at 59.65. And in the E-mini S&P 500 index, which is what this is, that move right there actually represents a $1,150 profit per contract. So if you scale that up slightly, you could see it's not a bad payday. And fun fact, what you're looking at there, what those arrows are pointing at, are literally a 1-minute candle. So that happened over the course of less than 60 seconds. Now, to set expectations, that's not how this goes in general, but there are interesting opportunities that pop up like this. And actually, the fun thing about this specific trade is I ended up trading it both ways, because a lot of times with this specific scenario, people will pile in expecting a big down move. Then people will start taking profits once you get your move, just like I did. But then that starts to actually rebound the market up before it chooses to continue down further or go up or whatever. So I actually traded this candle two directions. This is just one part of that trade. So this is a cool part about futures. You cannot do this with stock, and you'll see a couple other really awesome benefit when it comes to trading futures. The first thing is that they are another form of derivative. The origin of futures is actually really interesting. It was designed to stabilize prices, because if I'm a farmer and I grow crops and I don't know what the grocery store might need next year, and if I go through the full year and all of a sudden the grocery store doesn't need as many, well, that can put me in a bad spot where they're either going to buy less or the price might go down because a lot of people had a great harvest. So the whole point of futures is really to stabilize that kind of economy, and they're used today for that same purpose. If we take a look at something like a COT report, Commitment of Traders report, you'll see that there's a red line here. This represents commercials. So don't worry about all the other details. Effectively, what this means is this group of traders are people who are typically hedging some sort of risk in business operations, not looking to speculate and make money directly. So that means something like airlines. Airlines might find different ways to hedge the cost of fuel because they typically don't have huge margins. And if fuel goes too crazy, it can literally kill their margins. So that's really what futures are designed to do, stabilize prices. One of the really neat things, which I'll get to a slide in a second that gives you a complete breakdown of different kinds of things you can trade, but you also can gain access to stuff you do not have direct access to otherwise. So these really are the indices outright. You can trade that with options. So like think SPX, that doesn't really have a super unique taste to it, but commodities do. So you can actually trade underlying commodities themselves. So things like gold, things like oil, things like hogs, corn, wheat, soybeans, cocoa, oranges, so on and so forth. The cool part about that is you can get direct access to the specific thing you want to trade, for example, gold. Otherwise, you might have to trade a ETF that isn't outright gold. It'll have some other stuff, cash components to it, or trading gold miners. You can also trade things like volatility outright. The keynote version of all that is that you gain access to stuff in some instances that you don't otherwise have access to, which is very cool as a trader. So why might we trade futures? Well, I just gave you one example before in terms of access. Futures essentially trade most of the day. It does close for an hour each day, but then it'll open up at 6 p.m. Eastern time. And then it'll close down Friday afternoon, open back up on Sunday. That's for the indices. Now, one of the things that you will find with futures is that they're very nuanced. There's a lot of different rules based on what you're trading, which I'll show you how to navigate all that in a little bit. The other really neat thing about futures is the leverage that they provide. If we take a look at the margin requirement for the E-minis, which again, we'll get more into detail on what these are, the maintenance requirement for margin is 21,537. So what does that actually mean? Well, if we take a quick look at the notional value that you can control with one contract of the E-minis, it's $312,500. In order to hold that position, you have to put up 21,537. It's literally 14 and a half times leverage. So you can get massive leverage. Now, this can also be very dangerous for leverage gives and leverage takes. This is why one of the issues I have is a lot of other creators out there say like, oh, these are great for small accounts because there's no pattern day trading rules and because of the leverage, which might be the case, but I would argue the opposite. The amount of good that a small account is going to be able to do in something like this is very trivial, and they're more likely to take a lot of bad risks, build bad habits, and not have something to show for it long term. I actually think futures are great as an add-in to a total portfolio because of the access it gives you, and then it's also a simplifying function. So notice how I highlight simplicity here. Now, we're going to talk about some concepts of a futures contract that really don't seem that simple. But if you think about it compared to options, in options, you have to deal with a lot of other stuff. You have to deal with delta, you have to deal with theta, gamma, vega, all these different Greeks that can cause a lot of problems for the position. The cool part about trading futures is that if you're trading the futures contract outright, which are up here once they load, you'll notice that you're just trading the thing itself. This is what we refer to as a Delta One product. So it's very similar to stock in that way. This doesn't have gamma. This doesn't necessarily have theta. It has a version of theta called carry, which is a whole other thing in a whole other video. You don't have to worry about that too much. The main thing to take away from this is that it is a generally Delta One instrument. So that makes it much simpler. You're essentially trading it directionally, up or down. And there are some tax benefits, Section 1256 of the tax code for trading indices outright. So 60-40% long-term to short-term capital gains tax. So let's see what's inside a future. We have an underlying. We have a contract value. We have a tick size in value. I'll explain what all these mean. We have a corresponding expiration. There is a type of settlement, physical or cash. One thing to note on settlement is that even if you're trading something, for example, like crude oil, which is a physically settled product, if you use a retail broker, they effectively won't allow physical delivery. So there's not like this big risk that if you forget to roll your position, that you're gonna show up with tons of oil at your front door, 1,000 barrels. It doesn't work like that. Your broker is either going to close the position for you, roll it for you, but you do need to know about that because you have to check with your broker if they have some sort of policy around settlement. So that is something to know, that there are certain names, which I have a list for you in a moment, that are physically settled. Maintenance requirements margin requirements, initial maintenance, there's intraday. That just talks about the leverage that they provide. The other couple things that I do want to mention really quickly is this idea of carry. I'm not going to go into detail, but leverage is never free. So even though we're stripping away stuff like theta decay, which is the typical cost to leverage, there's still a version of that in futures. There's a way to calculate it that's not too complicated. But the thing to know is that in general, it's not massive. So you should know it's there. I don't want to go into detail, get bogged down in this video on it, but it's not overly significant. And then, like I said before, the main thing is you're pretty much going to trade futures in one of two directions, long or short. So it simplifies a lot of stuff about it. So if we want to learn more about a futures contract, you can actually go to the CME Group, who's the primary provider, and you can take a look at something like the E-mini S&P 500. So it gives you the Globex code. This is the ticker that it trades on. The platforms are slightly different. And you'll notice that there's a U5. What's that U5? That represents the expiration. It's kind of an annoying thing, but you'll notice how U5 equals the September expiration. And then Z is December, H is March, and so on. So these letters represent a month. And again, they're slightly nuanced. The cool thing is the platforms make it a little easier, but that's what those are. And then your broker might have different ways to access these. So for example, in Thinkorswim, you notice how it's /ES. So it might be slightly different based on your broker. So you can go through and see what this thing generally is, how it is calculated, where it trades, the trading hours. It gives you pretty much all the details that you could want. You could see the settlement prices because this is something that is called an index. So they have a base settlement price associated with it so that you know what this is going to be calculated off of. Because remember, it is a derivative. So its value is derived by something else. And in this case, it's the underlying index. You can go through and see the rest of the contract specs, which we're going to talk about. Now, notice how we said before, there is a contract price, there is a tick price, there's a tick value, a handle value, which we will explain all of that right now. So if you take a look at, this is after hours, but if you take a look at the bid and the ask for the front contract, you notice how as it moves, you're only seeing a specific fluctuation. Do you notice that? It's in the cents side of the equation. What you should see is that it's literally only moving in 25-cent increments. Now, this is one of the tricky parts about futures, is that 25-cent increment is a tick size. That 25 cents does not equal 25 cents. In this context, every time that moves by 0.25, that equals $12.50. This is where things get a little confusing. The cool part is I literally have a cheat sheet that you can take a screenshot of so that you don't have to remember all this. You can literally just see what it is. So what that means is the minimum that this price can change is in a 25-cent tick value that are worth $12.50. So there's 4 of those in each handle or point, or a full dollar move equivalent, which is worth $50. So here's what this means. If we take a look at 3 different tools, we have SPY, which is S&P 500 index ETF. We have /ES, which is what we've been looking at for this time frame so far. And then we have /MES. This is a new thing that's very cool. These are called E-minis, which is the E-mini futures. These are called micros. So just like SPX has a 1/10th version called XSP, they now have these in futures, which are really, really cool because it starts to bring this to a logical level in terms of leverage and total size. Because you can take a look at the E-minis. Notional value on the E-minis for the S&P 500 is $312,500, which is absolutely massive. Then you can take a look at it on the micros, and it's sized down pretty significantly by 1/10, which makes this, again, a little more palatable. So you can see the contract multiplier. So if I change the price by $1, what happens here? What's my P&L? Well, if I'm trading SPY and SPY goes up by $1, I make $1. Easy enough. If I'm trading E-minis, you'll notice that even if it goes up by that same $1 from 62.50 to 62.51, that's not really $1. That's what we call 1 point or one handle. And that 1 point is worth $50. So if it goes up by 1 point, your P&L is $50. So in the comments below, if I change this by 50 cents, 0.50, what is the resulting P&L for the E-minis? If you know, throw it in the chat. Do the math. It's a good exercise for you. So if we pop that in there, $25. So now that we understand a little bit about the contract value, notional size, tick size, and value, we'll get to a chart that goes through all of it in detail now. So this is something that you'll be able to screenshot. This breaks down essentially a bunch of different futures. This is not exhaustive by any means. This is just some of the stuff that I commonly trade. And you can see that there are different equity futures, volatility, bond and rates, currencies, liquids like gold. I'm sorry, gold, not gold. Crude oil, nat gas, then metals like gold, silver, softs, corn, soybeans, wheat, cattle, hogs. They have a ton of different things that you can trade. I also note what the deliverable is. So this is the settlement component. If you'll notice, equities are pretty simple because it's cash. But as soon as you start getting into other things, you can have some sort of physical settlement, which is important to be aware of. This also breaks down what the tick size is, which is the minimum fluctuation, the value of that tick, and then the point value. So all of these things essentially amount to a completely different way to trade the market. Now, there's one other thing I want to show you, which is if you take a look, you'll notice that there's these different expirations, but you'll notice if we look at the volume, essentially all of the volume is in the front contract. That's important to pay attention to because the front contract is almost always the primary traded contract. It's going to be the most liquid. And there will be a period once this contract gets within a couple days of expiration, you'll start to notice everybody rolling. There's actually an entire trade built around what's called the roll yield, another video. But the main point is that if you start getting within a few days of the expiration of that futures contract, you'll see the volume shift to the next contract. But otherwise, we all just trade the front contract. And the cool part about this, as I mentioned before, is that the markets are very narrow and you can trade it both sides. So what that means is if I buy a future like this and I analyze what that trade looks like, notice how it looks just like long stock. And then if instead of buying, I chose to sell it, notice how it looks like short stock. The big difference here is that you have leverage. So whatever your standard analysis approach is, pretty much applies when you're trading futures. Now, there's an important caveat. When you're trading things like liquids, like softs, like some of these other more nuanced commodities, there are very important seasonalities associated with them. So you have to pay attention. If you're going to trade corn, there's different seasonality throughout the year as it goes through the production cycle for the crop itself. So you can trade it, but you should be aware of some of that underlying backdrop, which again, pretty easy to find out. So this is literally a crash course on trading futures. These are something that can be used to hedge a portfolio. I like to use them for overnight and weekend moves very frequently. Same thing if I'm trading earnings in something like NVIDIA, and let's say I'm getting ran over in one direction based on the after hours move. We know NVIDIA takes a big part of the S&P 500 or even the NASDAQ index. So you can actually trade futures against that earnings play to subsidize some of the move that's going to punch you in the face the next day. Overall, a worthwhile ad for those that are looking to round out their portfolios. If you have any questions, let me know. Be an outlier. See you guys later.